Okay, dear participant, we will now commence our program. Assalamualaikum warahmatullahi wabarakatuh. Good morning, ladies and gentlemen. The honorable guest speaker for our today's session, Professor Someya Masakazu from Nagoya University, the honorable head of Economic Department, Faculty of Economic and Business Universitas Brawijaya, Bapak Dr. Rerpol Ferry Prasetya, and all the audience for today's sessions. My name is Girindra, and it is my pleasure to welcome you and serve as your master of ceremony in today's agenda, guest lecture, Bond Market Development in Developing Countries, Issues and Challenge. This agenda is a part of 3-in-1 lecture series held by the Department of Economics, Faculty of Economic and Business, Universitas Brawijaya. A bit of introduction for our 3-in-1 programs. It is one of the signature programs of Universitas Brawijaya, starting from 2018, in which we hold a special lecture session inviting many academicians and professionals who are experts in their field to give a special lecture to our students. Before we start with our agenda, let's first listen to the opening speech from the head of Economic Department, Bapak Dr. Erpol Ferry Prasetya. The screen is yours, Pak.
Thank you, Kirin. Bismillahirrahmanirrahim. Assalamualaikum warahmatullahi wabarakatuh. Selamat pagi. Good morning, everyone. Very warm greeting to our distinguished guest lecturer, Professor Masakazu Someya from Nagoya University, Ohio gozaimasu. And for all the participants and all our students, as a head of economics department, I am more than grateful to stand here and welcome you all to our 3-in-1 program as mentioned by Girin. Yeah. As a part of 3-in-1 program, our guest lecture today by Professor Someya will not only guide us, but also educate us regarding a variety of the pertaining to bond market development in developing countries like in Indonesia, regarding the issues and also the challenges. And we are thoroughly grateful for this prospectus and also for the vital aspect regarding to this topic will be convince you all. And I wish this guest lecture enlighten us all and provide us with the approach to deal with the problem of tomorrow. And once again, thank you to everyone who made this program possible with your opinions and all your views. And also to Professor Someya, thank you again for coming to our guest lecture. I think this is the third times you come to our this guest lecture. Thank you all. Assalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam warahmatullahi wabarakatuh. Thank you very much, Bapak Ferry, for the opening speech. And now, before the ink is dry on the page, let's start with our main event, a guest lecture from Professor Someya Masakazu, which will be moderated by one of the lecturers of the Department of Economics, Ibu Vita Devia, PhD. To Ibu Vita, the screen is yours.
Okay, thank you, Girin. Okay, Honorable Dr. Paul Ferry Prasetya as the head of the Department of Economics, Faculty of Economics and Business, University of Brawijaya. Honorable all of the head of the study program and all departmental staff, and honorable all the audiences today. Assalamualaikum warahmatullahi wabarakatuh and good morning. Okay, I'm Vita Devia as the moderator today. Welcome to the 3-in-1 study program for international lecture series. Okay, first let me introduce our invited speaker. He is Professor Masakazu Someya from Nagoya University. This is the second time I meet him in the 3-in-1 lecture series program, and it's an honor for me to meet you again, Professor. Professor Someya has educational history as follows. First, in April 1982 until March 1987, he studied in Meiji University, Tokyo, Japan. And October in 1991 until October 1993, he got MSc in Economic Development, University of Salford, Manchester, UK. And April in 1995 until March 1998, he got PhD program in Graduate School of International Development, Nagoya University. In July, in July in 1998, he got PhD in International Development from Graduate School of International Development, Nagoya University, and last in the September 2004 until August 2005, he studied in Graduate School of Economics, the University of Virginia. He also have many publications, such as in 2019, the title is The Impact of Shifting to Floating Exchange Rate Regime in Egypt, in Chiba Keizai Ronso number 59 in Chiba Keizai University. And also he has the publications in 2010, the title is Medium Term Macroeconomic Outlook in East Asian Economic Outlook, OECD, and many more that I cannot read one by one. Yeah, he has many publications. Okay, today Professor Someya will present about bond market in the developing countries, issues and challenges. Yeah. As we know, bonds are one of the investment alternatives that are considered the safest from risk and provide definite and non-fluctuating returns, in contrast to stocks that have high volatility. Okay, today the topic will be thoroughly discussed by Professor Someya, especially regarding its development in the developing countries. Okay, Professor Someya, you have approximately 2 hours to present the materials, and after that we will have the discussion sessions. And during the presentations of the Professor Someya, for the audience who want to ask, you can write in the chat columns, or you can raise your hand directly in the discussion sessions. Okay, Professor Someya, the time is and screen is yours.
Okay, thank you very much for inviting me. This is the third time for me to present here. It's my pleasure and honor to present here. All right. Okay, let me start. By the way, yes, you can make a question anytime through perhaps chat, as well as you can raise a hand, and then this is kind of usual practice for me in my lecture at the graduate school. But I may ask you, some of you, about your thought or opinion or comment. I may give you some questions. I may ask you to answer to these questions. I'm going to pick up whoever in the participant. So if you don't want to be, if you don't want to answer, please feel free to let me know. I'm going to ask somebody else. Okay, let me start then. Okay. Right. Okay, bond market development in developing countries, issues and challenges. the topics bond market is very much advanced, and then perhaps most of the audiences today is undergraduate. So I'll try to explain in a way that you audience can understand. And then perhaps initially I thought about market development in developing countries, or maybe this is a good opportunity to present in Indonesian universities. So I'm going to talk about some Indonesia's related development after COVID-19 in the Indonesian bond market. Okay, let me start. Why it doesn't move? Yes. Okay. Okay, as you may know, COVID-19, we have, this is the third year of COVID-19, which started 2020. And then that affected the bond market a lot, including Indonesia. This is the chart which describe debt, inflation, and the fiscal balance of Indonesia. A blue line is shows inflation. By the way, inflation in Indonesia is rising 2022, but this is up to 21. And then gray bar shows government gross debt to GDP. And orange line shows fiscal balance. Okay, I mean, a clear difference between before 2019 and 2020 is fiscal balance aggravated. 2019, it was -2% of GDP. 2020, it's -4.5. That actually has a consequence on a debt. But gray bar chart showing sudden increase in debt, government debt. That is actually means actually the bond market is developing. So, and then let us look at how bond market has been evolving in last 3 years. Okay. Please take a look at the chart on your right-hand side, bond yield. It shows gray line shows yield of local currency and of Indonesian government bond, and red dotted line shows Indonesian government bond denominated by US. As this chart shows, upon the COVID-19, government yields jumped both in local currency as well as US dollar denominated bond yield. So that's actually a very sharp increase. This means actually, okay, let me, and then let move on. But I will explain the relationship yield and bond price later on. Okay, and then this chart on your left-hand side shows the difference in yield. That is Indonesia bar is in red. So this bar shows the difference between December 2019 and March 2020. So this shows yield went up, jumped before the COVID-19 and after COVID-19, which is actually large, very large. But if you look at this carefully, Okay, Indonesia is IDN, but MYS Malaysia and PHL Philippines and China CHN on your maybe right hand side. They actually the jump in Indonesian yield, bond yield, is actually much higher than the peers in ASEAN and East Asia. Okay, on the left hand side, I mean right hand side, this is this is local currency yield um, um, as of August 2020. It's very high, Indonesia. Okay, so what I want to show you, I want you to understand is actually upon the COVID-19 yield jumped up in Indonesia. Okay, this is, let me explain a little bit about the relationship between yield and bond price. Okay, this is a market operation, open market operation. This is the bond market. Yeah. And then bond market, when issued, its face value is 100 always, 1 or 100. Yeah. And then blue line downward sloping is bond demand curve. And then red line upward sloping is supply curve. Okay, how? Okay, so right now, equilibrium bond price is 60. Okay, so this means you buy bond at 60. Let's say this is 1 year maturity. Tenor is actually 1 year. So you buy bond at 60, but 1 year later, at the end of the maturity, you return this bond to government and then you get 100. That means you are going to, your yield is something like this. Let me, okay, let me explain a little bit. Okay, so you bought your bond at 60, but if you hold this equity, I'm sorry, this bond at until end of your maturity, then you get 100. So your yield of this bond is something like, well, this is actually ridiculously high, but your yield, which is a return of your bond, is 67%. So this is how you compute. Okay, and then that's why your bond relationship, your bond. Sorry, what happened? What's going on? Oh, okay, very good, good. All right, relationship between bond price, which is shown in red bar, and yield, which is shown in red arrow line, is quite opposite. When the bond price goes down from 60 to 52 something, then bond yield goes up, which is shown in the right hand side. Right hand side, 100 minus 52 over 52, 82. So it was 67%. Now, because bond price decreased, as a consequence, bond yield jumped up. So what happened after COVID-19? Jump up in Indonesian bond yield is actually bond price went down. Okay, bond price went down. Why? Well, that means that actually is actually shown here in the chart on your left-hand side. Okay, as you know, COVID-19, under COVID-19, you have to spend, a government has to spend a lot of money in order to rescue people, right? Government has to buy short injections, as well as government has to help hospitals. And that's why actually government spending increased. As a consequence, government fiscal deficit increased, fiscal balance decreased, and the fiscal deficit increased. That we saw it in previous chart, right? So when the government runs higher deficit, then you issue bond to borrow money. Yeah. So as a consequence, supply curve of government bond, which is supply curve is thoroughly, mostly government issuance of the bond. Yeah. Increased. Government increased its issuance of bond. So that's why actually government, supply curve of bond shifted from to the right. So shifted from red line to green line. As a consequence, equilibrium bond price decreased from 60 to 52. Then, which means actually government bond yield jumped up. Okay. So let me move on. Why it doesn't? Okay. Okay. All right. Good. And then okay. So what is what is the behind this phenomena? Okay. All right. Well, I have to tell you another reason for okay, maybe I should keep this one. Another reason why government bond price fell and the government bond yield jumped up is maybe not maybe, but it's another. We saw supply increased as well as demand decreased. So demand decrease means demand curve shift to the left. As a consequence, demand curve demand declined and supply increased. As a consequence, Indonesia had a huge jump in yield. Yeah. All right. Why demand declined? We know why supply increased, because government was running higher deficit to help people. And then why demand decreased? This is a kind of key factors in Indonesian government bond yield jumps, right? That is, if you look at the chart on your left-hand side, share of non-resident holding of local currency government bond. And then blue bar shows the share of non-resident, which means share of foreigners of government bond. Blue bar shows that of emergency market, and then green bar shows Indonesia. So in case of Indonesia, after around 2008, maybe 7, perhaps before 2006, 2004, 5, the share of foreigner was very low, but it's increased. And then as of 2019, the share of foreigners is actually 40%. And then okay, and then please look at the chart on your right-hand side. That shows share of foreigners in government bond as of 19. So which is actually, in case of Indonesia, it's more almost 40%. which is actually very high compared with other developing countries. PR, Peru, and then ZAF, I'm not sure ZAF, but Russia, Mexico, and then compared with Thailand and Malaysia and Philippines, which are shown in green bar. Those compared with those ASEAN countries, peer ASEAN countries, Indonesian share of foreigner in government bond is very, very high. Yeah. Okay, and then the chart on your right-hand side shows the difference between before COVID and after COVID. Share of Indonesian share of foreigners in Indonesia at the end of 2019 is almost 40%. Yeah, and then second quarter of 2020, it's 30%. That means foreigner sold Indonesian government bond. This is actually huge compared with emerging economies. The share of foreigners in emerging economy at the end of 19 is almost 20%, and then Q2 2020 it's almost 20%. Yeah. So okay, as we know, there are two reasons for government yield jump. One, government deficit. Another one, demand declined. And then one of the factors for demand declining demand was actually foreigners. Foreigner sold government bond. That's the reason. That's one of the reasons why yield jumped up. And then please look at the chart on your right-hand side. Share of non-resident. This is actually change. Yeah, the same change on the right-hand side. This change is huge compared with other countries. So that's we know, we see. All right, this is a local currency bond net outflows and US dollar bond issuance. Okay, if you look at the green chart, this is local currency government net outflows in 2000. So outflow is huge, and then more than US dollar denominated bond issuance. That it shows. Okay. All right. Okay. Yes. This is the difference. I mean, growth rate of government bonds compared with other episode. Okay, this is nothing to do with Indonesia on the chart right-hand side. This shows major emerging market. COVID-19 is huge. COVID-19 during COVID-19, emerging market issued bond very much. It's actually almost 60%, which is almost same as global financial crisis, GFC, paper tantrum. This is paper tantrum is actually U.S. Federal Reserve announced they are going to raise interest rate in 2013. At that time, capital outflow was obvious. Yeah. So, okay, foreigner sold U.S. government bond and then take the money back to the their own countries. So that's why actually government bond demand for government bond fell and capital outflow. This shows LC government bond net outflows. Okay, and then in case of Indonesia, Indonesia issued lots of bond. This shows on the on your left-hand side, I mean right-hand side chart. Compared with right-hand side, in case of Indonesia, Indonesia government issued bond a lot during COVID-19. Well, issuing bond, I don't know, people, you may have some bad idea. Issuing bond is no problem. When you need money, you have to issue bond. And then some countries which has very low income countries, they cannot issue because nobody buys. But in case of Indonesia, the international capital market buys Indonesian bond. That's why actually Indonesian government was able to issue bond when it's necessary during COVID-19. But as a consequence, I'm sorry, as a consequence, yield jumped up. All right. This is also this is actually this is showing the difference between yield differentials of Indonesian government bond denominated in local currency and that in dollars. So this is the yield. So actually, this means local currency yield of Indonesian government bond jumped higher, much more than the yield of Indonesian bond denominated in dollar. So that's means Indonesian government bond denominated in rupiah was sold more than Indonesian bond denominated in dollar. Why? I'd like to ask maybe some of you why differential widened. So this chart shows investor sold Indonesian local currency bond more than Indonesian dollar currency bond. So this is why. If question is why. Perhaps let me ask. Oh, sorry. All right. Let me. Okay, and chat or maybe participant. Oh, we have so many participants today. Thank you very much. I really appreciate. Something. Okay. Oh, okay. All right. Participant. Okay. Okay. Who is going to? Okay. You have many people who have a sometimes same name. All right. Let me ask. Okay. By the way, yes. Okay. Ahmed Akbar, Mr. Ahmed Akbar. Are you there?
Okay, Mr. Ahmed, are you there? Or is there anyone else who wants to
Yeah, that's
answer?
fine. That's fine. Yeah, that's fine. Yeah, that's fine. That's fine. It doesn't have to be him. Anyone?
Anyone? Or maybe if you, for the audience, if you have some opinions, you can write in the chat column, maybe.
Yeah, chat is fine. Okay, Okay, one of the reasons why people sell more local currency bond than US bond is the difference between local currency bond and the US dollar bond. I mean, as you can guess. Well, what is the difference? The difference is the same. Difference is actually is not the bond is maturity is the same, but difference is actually currency. Yeah. So local term currency, it's all right. Okay, main investors who sold bond was, as we saw, it's foreigners. Foreigner means, let's say, U.S. investors. U.S. investors, for U.S. investors, which one is safer? U.S. dollar denominated government bond or local currency denominated government bond? Of course, U.S. dollar denominated government bond, right? If you means if the U.S. investor buys local currency rupiah denominated government bond, it involves exchange rate risk, right? When exchange rate depreciate, then the value of your bond falls. So that's why actually, but in case of the dollar denominated bond, it never happens. So, all right, those who sold government bond very much, it was actually foreigners, foreign investors. Foreigner sold, and then which one? Government bond or rupiah bond or US bond? Of course, foreigner sold rupiah bond. That's why actually there's the differential in yield between rupiah currency denominated government bond and the US dollar denominated government bond. Okay.
Excuse me, Professor Someya.
Yes.
Professor Chandra has
okay. I see. I'm very sorry. I'm very sorry. You see, the background is red, so I couldn't recognize. Okay, please.
Okay. Arigato gozaimasu. Good morning, Professor Masakazu Someya-san. I would like asking about some issues since we have a pandemic from 2020, 2021. And we are hoping that 2022, the pandemic will be going to be endemic. But when we see how the many governments finance the crisis, this is very interesting. So some government in some other countries, they are trying to make deficit with helicoptering money. So they are distributing money. The money coming from could be a central bank and creating money for money supply. And now we see the consequence of the policy that the inflation rate in many countries increasing very high. But for the government of Indonesia, the financing of the pandemic or the deficit is through government bond. But the interesting one is the government bond, it's sold to central bank.
Yes.
Although there is also a big debate, since the central bank should be independent, and now the central bank should be obey to the government to reduce the pressure of foreign debt of our country, because the debt country is very high now. Although according to the regulation, the ratio debt to PDB is should be maximum 60%. As now, our debt ratio is, I think, it's about 40%. So this, according to the law, this is still okay, right? But for the central bank, they have another pressure, because many economists in Indonesia see that our central bank is not independent anymore. So they have to collaborate with the government to keep the Indonesian economy still going. And now we see our strategy could be said it's good, because our economic growth is still high comparing to other ASEAN countries. And Now maybe the other pressure is since the inflation rate in many countries increasing. Now the interest rate is going too high too. And the consequence of this, as you know, the holding of government bond of Indonesia, I think before crisis, before 2020, it was about 30%, right? Now it's going to be, I think, 90%. So many foreigner they sold the government bond of Indonesia. So the consequence of when we want to increase the interest rate, it means the yield of our government bond should be increasing too. And it means there will be a pressure for our government budget, right? In the next future, maybe in the 3rd or 5th year. So do you have any idea how to overcome the problem? Because this is not so easy as a policy choice for Indonesian government. Thank you, Prof.
Okay. All right. I'm very glad to have your questions. And then your concerned about monetary operations. That's actually a central bank buys directly from the government bond from the government. Some countries actually prohibit monetary operation constitutionally. It's against constitutions. But some countries are not. In case of Japan, it's more almost constitution, I mean, against constitutions. As you know, we had a sort of active military period before 2000, I mean, Second World War. And then we spend a lot of money to improve military. Did we have money for that? No, actually central bank, government issued a bond and the central bank bought it from directly from the government. That's why actually we are very much against central bank, monetary operations. And then, but some African countries and also some countries actually under this emergency situation of COVID-19, they are doing not just Indonesia, but also Brazil and Iraq, many countries. And then the consensus about the use of monetary operation here under COVID-19 is perhaps, okay, central bank, as Mr. Andra, Professor Anandra mentioned, central bank lose maybe credibility, but the need to rescue people is actually, is there present. You cannot, okay, you cannot say, hey, I cannot help you because we don't want to, we have to have independence. Central bank, that's why actually it's the consensus is okay to use monetary operations. And then in Japan too, okay, we are not directly, central bank is not directly financing government through buying government bond in the primary market, but central bank has been buying a lot of bonds through secondary bond market. So that's why actually what people are, country are doing almost same. Just the matter of it, if it's primary market, it's monetary operation. It's if it's secondary bond market, it's open market operation. That's all. But okay, let me. Okay, this is another chart. Oh, sorry. This is a net claim on central government and asset and the monetary liability of the central government, central bank. So this is a balance sheet of central bank, Bank Indonesia. And then orange line shows monetary base. And then that's actually liability to the central bank. And then blue line, blue bar shows central bank's net claim on central government. That means actually monetary operations. Central bank buys asset, a bond from the government. That's actually asset to the central bank. Okay, this is okay. Look at the perhaps Q2, Q3, Q3 and Q4 of 2020. the blue bar sharply increased, right? That's actually because of central bank. It's because of monetary operations. But if you look at the Q4 and Q3, it was okay when in 2020, because if you look at the difference between liability and asset, there is a huge kind of space, right? So as long as there is a space, then if central bank buys bond, but it doesn't give pressure to money supply. Yeah. So that's why no pressure on the inflations. But if you look at the 2021, it's almost equivalent. That means if the central bank issue more government bond, and then if central bank government issue more government bond, and then if central bank buys more government bond, that's actually going to be a pressure for inflations. So it's maybe inflation pressure started very in a silent way in 2021. That's what I guess.
Okay.
Yeah, and then in case of interest rate increasing, that's also your concern is actually shared by economists on the globe. Yes, right now, because in addition to COVID-19, we had a supply problem because of COVID-19. That's actually one of the reasons for inflationary pressure before Russia-Ukraine war. But now we have a Russia-Ukraine war. That's actually additional inflationary pressure, because Russia is a 10% producer of petrol, and then 10% producer of petrol, as well as 20% of producer of wheat, food, as well as wood. Russia produces a lot, so that's why actually inflation. We know inflation is rising, and then, but we know because of Russian war, GDP outlook of economic growth is gloomy. If economy is rising, and then economic growth is rising, and then inflation rising, it's okay. You can raise interest rate. But now inflation is rising, but GDP may fall. Under that situation, if you raise the interest rate, it's gonna be a disaster for the economic growth. That's as Professor Ananda is also worried. This is actually shared by many economists.
Yeah.
Thank you very much.
Okay. Thank you, sir. Arigatou gozaimasu.
Okay, so I just wanted to I just explained this chart with the help from Professor Ananda. Okay, and then let's move on. All right, one of the reasons why foreigners sold government bond in local currency is the difference. It's not dollar, but rupiah. If you look at this chart, exchange rate fluctuates a lot upon COVID-19. Rupiah depreciated. Well, not only rupiah, but also many currency of developing countries depreciated a lot at the time. Around 2000, upon the COVID-19. Let me, where is the chart? Oh, no. Oh, yeah, here. Okay, here. Around here, huge jump of depreciation of rupiah, which is observed in many other developing countries. Okay, and let me move on. Okay, all right. Indonesia, in case of Indonesia, volatility of exchange rate, we observed in, volatility. Well, not just Indonesia, but many other developing countries. Exchange rate fluctuation observed 2020, and then that is also higher, a little bit higher compared with other emerging market. It's not really high, but compared with your peer in ASEAN, Philippines, Thailand, and Malaysia, a little bit higher. Okay, let's move on. Okay. All right. So what about government? Bank loans. This is bank loans. Loan growth is very stagnant under the COVID-19 era, which is shown in both chart. COVID-19 era, all of the loans, total shown in red line, foreign currency denominated loans, and then private and joint loans, and the SOE and regional loans falling under the downward trend. Okay, in this situation, all right, bank has to be careful about extending loans because their liability side is actually deposit from the Indonesian people who save maybe because she wants to use after retirement. So this is very important money of the nation. So that's why actually banks has to be very, very, very much careful about the use of loans. But you know, the economy needs finance. How you finance while banks are very careful? It could be bond market, corporate bond market, and then in order to promote corporate bond market, government bond market has to be promoted first. So that's the reason I picked up this topics. Government bond market. Government bond market in developing countries. All right. Okay. This is in case of Indonesia. Red line shows government bond market capitalization, government bond to GDP. It was very low in 97, 98, but 99 it jumped because of Asian financial crisis. Well, Indonesian government didn't want to issue, I guess, but in order to borrow from bilateral donors or maybe international institutions, they had to issue bond. And then, so that's why actually bond capitalizations jumped up in 2019, 1999 and 2000. And then gradually, Indonesian government paid back. And then 2013, it started increasing. Perhaps by that time, this is my guess, but the Indonesian government paid back everything. Okay, but actually, this is the impact of Asian financial crisis is disaster, very bad. But one good consequence is actually government bond market expanded. Why you need a government bond market? Why okay, all right, because if you bought, okay, what are the alternatives to government bond market when government runs fiscal deficit?
Bond market.
When the government runs fiscal deficit, government need to borrow. Where? Other than bond. Other than bond. Other than bond. That's actually international financial institutions, IMF, World Bank, or donors, right? If you borrow from IMF, World Bank, it takes time. In terms, negotiation, it takes time. So, but you need money today to help people, yeah. But it takes time, 3-4 months, and then sometimes World Bank loans or IMF loan comes with conditionality. You have to do this, you have to do this. So that's actually constraint, that can be a constraint for the government policy. But and then if you borrow from, let's say, other countries, you know, oh, I'm from Japan, but you know, this bilateral loan always comes with political, hidden political interest. Yeah, so it's not free. Although interest rate may be low, but it's not free. But if you have a government bond market inside domestic government bond market, you just issue the bond. That's all, and then you have no exchange rate risk, or know political string. I mean, strings comes with, which comes with usually with bilateral loans, and also it's very quick. Yeah, and then no conditionality. So that's why actually after 2000, many developing countries promoted government bond market, and so that's why actually promoting government bond market become very much one of the policy issues. Okay, so let me move on to government bond market promotions.
Excuse
Okay.
me, Professor
Yes.
Someya, before you continue, we have questions from
Okay, sure, go
Muhammad
ahead.
Faisal Fadil.
Yes.
Yeah.
Okay, go ahead.
He has a questions about the exchange rate, which was shown in your presentation. Yeah. Does Russia's and Ukraine war also influence the exchange rates of rupiah to dollar? And does this exchange rate also influence the prices of staple materials for Indonesian people to consume, such as, for example, rice and oil price? Thank you.
Yes, thank you very much, Professor Devia. Thank you very much for your help. All right. Yes. The solution. Yes. Well, as we saw, Russian-Ukraine war, because Russia produced 10% of world wheat, which is the material for bread, and Ukraine also produced 20%. So altogether, Russia, Ukraine produced 30% of world wheat. So wheat price went up very much. And also Russia produced petrol as well as cobalt, many rare earth materials. So that's why actually the price of basic need, food and petrol and many commodity are actually rising. And then, yes, Mohammed is right. Yes, because, okay, US is still enjoying high economic growth. So that's why actually US dollar, and then expectation that the Federal Reserve is going to raise interest rate. So in the capital market, interest rate is actually rising a lot. So that's in US dollar. So that's actually that's the reason for rupiah depreciations. When the rupiah depreciate and then the price of imported goods goes up. So so this is a sort of two impact. One, okay, commodity price goes up, is going up, and then also another one, because of depreciation of rupiah, the price of imported goods going up. So that's why actually lots of developing countries are observing the rate of inflation rising 8-9%, very much. Yes, so it's actually you are right. I have no actually. I agree 100%. Okay. Did I answer to you, Mohammed?
So exactly what's your pointing at? So on the exchange rate, that's wait. I mean the influences of the exchange rate of rupiah to dollar is actually the commodity itself. right? That's because that influences from the Russian and Ukraine war, and also the depreciation of rupiah.
Yeah, that's right. Depreciation of rupiah is actually triggered by the rising interest rate in the United States. I mean, expectations.
Okay. Okay. Thank you very much, Masakazu Sensei. Domo arigatou gozaimashita.
Thank you very much. Very good question. Very much topical question now, which is relevant, very much relevant to Indonesian economy, and then as well as other developing country economies. Thank you very much. Okay. All right. Let me move on to. Okay, now I'm going to move on to promoting financial market, which include government bonds. All right, financial market involves market participants who forge contract under some rules that are either mentioned and enforced by the participants themselves or by regulators. Okay, function of financial market. This is actually the same as bond market as well. Is consisting from borrower, lender, regulator, which is public sector, and then sometimes a financial service agency or sometimes central bank in charge, and then liquidity providers. Okay. Perhaps maybe I should explain chart of this one. Right. Let me start with, all right, transferring resources. Financial market transfers resources. Okay, financial market, let's say bond market, corporate bond market, transfer resources. All right, investor buys corporate bonds, and then that money is going to be used by entrepreneur for their project or maybe investment, building machine, or building factories or buying machines, and then pooling resources. Okay, one person one person cannot finance huge infrastructure project. So financial market receive lots of investment from many investors. So financial market can offer large amount of capital, money, which is pooled. Prices discovery. Well, as you know, market gives you price of the government bond, corporate bond, or equity. And then, which is good. All right. And then this is mentioned by Professor Ananda in his talk. All right. Yes. When the let's say government issue bond a lot, then bond price goes down, and then interest rate goes up, right? Who will be in trouble? Government, right? Government expenditure. One part of government expenditure is actually interest payment. So as interest goes up, the government's interest payment bill goes up, which actually further worsened fiscal deficit. So, but this is important because all right, right now we are under COVID-19. That's okay, but in normal era, sometimes government issue bond because, well, I don't think this is the case for Indonesia, but president wants to be re-elected. So every 4 years or every 5 years, it's called election cycle. When the country has presidential elections, issuance of bond goes up, right? But if there's no penalty, government keep issuing bond, but the price is interest rate going up is the sort of penalty to the government bond issuing unlimited bond. So this is good. And the clearing and settlement payment. All right, this is very important. when we had a huge earthquake in Japan, this was a target for central bank to protect. Yeah, if the settlement and clearing system is not functioning, and then so many entrepreneurs or companies are going into bankruptcy. And then thus managing risk. Okay, what risk? All right, investor take risk. Investor invest, but they take, that means actually they are taking risk. Right, that's actually they know. But so it's not well, investor wants to take a risk. That's why they invest. So we have, it's but some people suffer if this bond is not managed. Yeah, who? Okay, this is very important factors in terms of financial market development. Okay, if you remember Greek crisis, what happened in Greece was all right. Greece is one of the euro members. They are using euro, and then if you use euro, if you join the euro, there are three criteria that you have to meet. One, debt to GDP is less than 60% of GDP, and then inflation 3% of GDP, and then inflation rate of inflation 3%, and then fiscal deficit less than 3%. Okay, Greek government was saying we are actually meeting this criteria, convergence criteria, 3% fiscal deficit, 3% of GDP. But when the government changed it, and the new president was inaugurated, and then he found out deficit to GDP last year, previous year was 12%. So government lied. What's the consequence? All right, if you are an investor, you don't trust government who lie. So government, so that's why actually lots of investors sold bond, and then bond price went down. Who are in troubles? Okay, who are the investors of government bond of Greece? It's not just individual consumers or household, but also banks. So German banks and Italian banks, Spanish bank, they all bought Greek bond. All right, because at that time, because of monetary easing, interest rate was very low. So which means yield was government bond was very low. So the banks wanted to higher yield, which is actually which offered by the Greek bond. So when Greece had when under the Greek crisis, who suffered are the banks, Spanish bank, Italian banks, and the French banks, German banks. When the banks are in troubles, what happened? They don't lend, they don't extend loans. Who will be in troubles? Corporate sectors. And then when corporate sector invest, build a machine and build a factory and buy machines, they need to borrow from the banks. But banks didn't under the Greek crisis. So when the banks are in troubles, economy is in troubles. So GDP growth rate was very low at that time. So you have to manage risk. Banks have to manage risk, and then government has to manage risk as well. So when the government, so what we learned from Greek crisis is when the government isn't in troubles, banks are in troubles, and then economy is in troubles. Yeah. Okay, Professor Ananda, please.
Okay, thank you, Professor Masakazu Someya-san. I just want to know about the Japan experience during the pandemic, how they overcome the problem, especially how to keep the banking sector still working in proper. So as you know, from Indonesian experience, during the pandemic, the lending is very low. And as your presentation, I don't know which slide, I think 2 or 3 slides previously, it shows that the lending, the deposit money, the ratio deposit money to PDB, I think, GDP, is increasing because many people are afraid to invest in the real sectors. So they are going to the bank and put the money there and waiting until maybe the real sector is working improper in the future. So that's why we know what we call scaring effect. So the people are afraid to invest. They are also afraid to consume. So in Indonesian experience, the both sides, so investment, consumption is declining. So
Iya dah. Aku dimarahin, aku mintanya habis.
Dita, tolong di mute ya, Dita Yuliana. Atau dari hostnya di mute langsung ya. Terima kasih. Okay, please, Professor.
Okay, so this is the slide. I think so the number of deposit money in the bank increasing significantly during the pandemic, and this is actually normal rationally. So when we are afraid that the real sector will be bad or worse, so we are going to the bank. And the problem is when the bank bear the cost of the crisis, because maybe there are many debitors, they don't want to pay back the lending, so they cannot pay because the business is going bad. So this is the risk for the bank itself. The other one is since the data show in our country, the growth of credit, so the lending rate is, I think, is only achieve 4%, 3 points percent. So less, I think, according to the last lending rate in the last 10 years, this is the lowest one. So this is the consequence. The government through fiscal policy, bringing the money from the central government to the local government, and now we are facing the difficulties which sectors should be supported and which sectors should be maybe freely working. And in our country, only 2 or 3 sectors, they still can produce, can operate in the normal one, like in the health sectors, and also the food and beverage sectors, and infrastructure. So the interesting one is the bank sector is still going good because the policy from the government, because we also provided some subsidized credit. So we have also some relaxation of taxation. So some corporation get some facilities from the government, and all we see. I wrote an article two days ago in national newspaper that the national budget is actually the keeper of our economy at this moment. So I don't know how Japanese government overcome these all programs, because I see the handling of COVID-19 and also the pandemic in Japan is also good, with good result too. So I would like to know the Japan experience overcome the all program problem in economy. Thank you, Prof.
Okay, thank you very much, Professor Ananda. You wrote the article at the national newspaper, which exactly the same. The situation is exactly the same in Japan too, because the subsidized loans. Well, it's not subsidized, but it's subsidized as well as guaranteed. So zero interest loans with government guarantee were actually extended to SMEs. That's why actually totally different opposite to our expectations. The bankruptcy rate was actually very low last 3 years, particularly 2021. Bankruptcy was the lowest in last 50 years. Amazing. And then unemployment rate was also very, very low. And then, okay, this is quite opposite to our expectation. And then, as you wrote, yes, government is a keeper, and then government deficit, widened, and the government debt has been rising a lot. Yeah, that's actually we see many other countries. So same in Japan.
Okay.
Okay.
Thank
you very much. Yeah. Very good to know that Indonesia, same in Indonesia. Okay. All right, let's move on. Okay, so we talked about managing risk. Yeah. All right, let's move on. All right, borrowers. Okay, we know 5 players: borrower, lender, regulator, and liquidity providers. Okay, let's move on to borrowers. A borrower wishes to finance a project, but has an option of internal financing. That means actually internal financing, saving, out of saving, or retain the profit. Or borrowing externally. How wish list might look like this. Low borrowing cost. Of course, interest rate must be, the lower the interest rate, the better. And then second, infrequent interest payment. Of course, if you pay interest only maybe once per 10 years, much better than every month. And then full control over use of borrowed funds. This means lender do not intervene the use of money. And then no monitoring. So you're not monitored by the lenders, which is good. And long maturity. Yes, this is also what borrower want. No collateral. Usually, particularly SME has to put up the collateral, while big corporations like do not have to. Yeah. So these are the wish list, but that's actually exactly the mirror side of the lenders. Lender, on the other hand, who has excess fund to lend may have the option of investing in her own project or investing in their project. How wish list might look like this: high return on investment. Well, from investor viewpoint, the higher the return, the better. Frequent payment. That's actually also good for lenders. Lender wants to do that. They want frequent payment, full control over the money. Well, what lender wants is, okay, once lender extend the loans, give the money, lend the money to borrowers. Their concern is borrower do not misuse the money. Okay, such as borrower use the money for the project which has high risk and then which is not presented in the negotiations, something like this, which is called moral hazard. Once you get the money, there is an incentive for borrowers to do moral hazard things. Ample high value liquid collateral. Yes, liquid collateral is important. All right. Then what are the obstacles that prevent these participants from agreeing to a contract? Lack of sufficient borrowers and lenders. There is not enough lenders there are many borrowers, but not many lenders. That means not much liquidities. Borrowers and lenders cannot agree on the term. That means costly negotiation. If it takes time, negotiation takes time, then maybe borrower miss the business opportunities. So it's costly. Information is imperfect, asymmetric, that these lender cannot ascertain creditworthiness of the borrowers. As you know, this is always the problem in the financial market. All right, borrowers knows who he is or who she is, what the risk she has or he has, but lender doesn't know. As a consequence, good borrower doesn't borrow because she has to borrow at the average interest rate, which reflect more bad borrowers situations. And then only bad borrower participate in financial market. That's called asymmetric information and asymmetric informations. As a consequence, asymmetric informations market is full of lemon. Lemon is actually bad second-hand cars. Yeah, these are same. Yeah, if you are selling car, this is the car is bad, and then you know your risk. Yeah, and then but buyer of second-hand car doesn't know the risk. So as a consequence, and then the good second-hand owner, a second-hand car owner, will not sell because the price is average. So good car deserve higher price, but she has to sell at average. So as a consequence, the second-hand car market is full of lemon. Lemon is actually bad car, bad second-hand car. That's actually they happen in the financial market as well. That's 4. Rule of law as obstacle to contracting. That means existing laws may prohibit certain contracts. That is Yemen. Yemen law enforcement is very, very weak. If you borrow, when you borrow and you don't repay, you are not going to be punished. In that case, what happened? Okay, what happened is actually nobody extend loans. So nobody extend loans means not much investment, and then not much GDP growth rate. And then 5, monitoring and enforcement is costly. That means too expensive for lender to verify borrower action. Monitoring is very difficult. In that case, you don't want to lend. You don't want to give loans. Okay. And then what do we need to alleviate these obstacles? We need good governance, transparency, change in laws, and enforcement of existing laws. This is the this is for regulators. The third in this list. Okay, for regulators, stable financial market and the developed financial market and no financial risk. This is what they want, of course. Okay, liquidity providers. Who are the liquidity providers? Professional dealers and traders. Active financial instruments such as debt instrument of various maturities. If the financial market have offers many maturity instrument, 1 day to 10 years, 30 years, that will be the good for the countries. Sufficient counterparty to transact with, be it borrowers or lenders or other traders or dealers. Yes, if you have many customers, then which means if you have a many market participants, the market improves its liquidity. And then low transaction cost to justify holding large inventories and making a market in the instrument. All right, the transaction cost is important. First, and the secure clearing and settlement process to protect the integrity of the transaction. All right, this is first and secure clearing and settlement. Usually, okay, settlement is done after, after maybe 1 day or 2 days. It's called T+1 or T+2. By the way, when I was at the World Bank, I was involved in the financial market reform in Lebanon, and then our offer, one of the suggestion proposal is actually at that time Lebanese government in Lebanon the settlement is T+2. That means actually the money is settled after 2 days. 2 days after the order or transactions. Then that was maybe 20 years ago. And then I came back to Japan, and a few years, and then I started working in the Nagoya University. A few years ago, I heard the news that the Japanese government announced they are going to reform the financial market and then changing from T+2 to T+1. So World Bank was actually requesting better policy than Japanese government. Yeah. So, well, you have to be careful about bank and the IMF's proposal. It's too good sometimes. All right, and what would be the attractive instrument for dealer or traders? Large size of issuance, which would be oversaturated buy and hold market, sufficiently long trading life, that is long maturity or repeated issuance, sufficiently large turnover, which is multiple use for instruments such as government bond, attractive risk profile, ability to isolate, trade one risk, for example, using government paper as collateral to reduce credit risk of a borrower. So one of the benefit of promoting debt government bond market, particularly secondary bond market, is actually the use of collateral for investors in the financial market in other, not just the government bond, but the financial market itself. Usually when you borrow, particularly among banks, 1 day, 2 days borrowing requires actually holding collateral or holding government bond as a collateral. So if you have a government, if you know your counterparty, a borrower has a government bond, which is actually registered at the depository, so you know who is the owner. If the collateral is maybe diamond, in that case, you may, when borrower borrow, he or she has a collateral, diamond, but after that, you may, he or she, borrower may sell it, which lender doesn't know. That is a problem. But in case of government bond, it's registered, and then it's very quick to know who is the owner of this bond, which is collateralized. So when you have a government secondary government bond market, and then if the financial transaction use government bond as a collateral, that actually boosts up the market development a lot. Okay, market enabling policy. Market enabling policy helps push financial system closer to the frontier and include more short to medium term policy and regulatory reforms. For instance, policy aims at fostering greater competition can result in efficiency gain, illustrated by recent vigorous expansion of profitable micro and consumer lending across many developing countries. Micro finance is very popular. Such policy may also include removing regulatory impediment and reforming tax policies. Okay, in case of microfinance, actually, microfinance very famous for tackling poverty, but actually it's lots of researchers found microfinance is not very helpful for reducing poverty. But some other researcher found out microfinance is actually helpful in terms of improving financial inclusions. So microfinance used to be an instrument for low-income people, but now microfinance is now the instrument for SMEs, small and medium-sized enterprises. Okay, and the enabling policy is not just limited to facilitating new entry and contestability, but also include activist competition policies such as opening infrastructure, financial infrastructure. That means the payment system and credit registries to a broader set of institutions, or forcing institutions to share platform and infrastructures. All right, market harnessing or market stabilizing policy. Stability in the market is crucial, we discussed. The market harnessing or market stabilizing such policy encompassing risk oversight, monitoring risk, the management, risk management, and including regulatory framework, which as well as macroeconomic and macroprudential management. Regulatory framework means actually, okay, for example, bank has to have a own capital, maybe greater than 8% of asset, something like that. If you have a more own capital, you are less vulnerable to financial crisis. And the macroeconomic and the macroprudential management is actually, let's say, government periodically check the banking sector and the market. It also involves upgrading regulatory framework to mitigate risks stemming from increased competition from new non-bank financial service providers, foreign financial institutions, or foreign borrowing, carefully calibrating the pace of financial liberalization to prudential oversight capacity, and establishing cross-border regulatory frameworks to mitigate risk stemming from increased international financial integrations. And such policy important for the users. Minimizing risk of the household over indebtedness through financial literacy program or consumer protection framework. So this kind of market stabilizing policy is actually good, helps actually users as well. All right, financial development. Okay, financial development is multidimensional because it covers 3 dimensions: financial depth, financial efficiency, and the financial inclusions. Okay, all right, financial depth means actually you have to have a large size, and then many players, not just banks, but also security house, or sometimes pension institutions. And then financial efficiency, this means the market has to find out the price very quickly. Otherwise, it doesn't function. The function for price finding is weak. And then financial inclusion. This is a topics which was very popular last maybe 5-6 years. That means financial access to it should be available for wide range of households, low income to high income. Okay, all right, let's move on. All right, okay, this is not very okay. Let us move to financial structure, bank-based versus market basis. Okay, is financing through banks better than through capital market or corporate bond market? or vice versa? Are some financial institutions better suited to the early stage of development than others? Okay, I guess in case of Indonesia, it's more like a bank centric bank. Um, uh, it's indirect financing rather than direct financing. Indirect financing is actually banks. Banks plays a large role, and then direct financing market is actually something like equity, stock market, and corporate bond market plays large role. Okay, and then in case of Japan, we are more like a bank centric, indirect, so bank-based market. While maybe Germany, Italy, and French, many of the European countries are bank-based, while United States and the UK are more like market-based. What is the difference? Well, in the early stage of development, stock market doesn't play much role. Why? Why early stage of development stock market doesn't play much role? Okay, perhaps you know the reason. Professor Debia, may I excuse 3 minutes?
Okay, sure, Professor.
I'm sorry. So the question is, why direct financing, a market-based financing is not really, I mean, stock market doesn't play in the early stage of financial development. When I come back, I'll ask.
Oke, mungkin untuk audiens nanti bisa meninggalkan jawaban mungkin atau opini di kolom chat, atau mungkin ketika Profesor Someya kembali bisa langsung menyampaikan jawaban atau pendapatnya. Silakan, tidak usah malu-malu atau tidak perlu ragu ya. Di sini kita adalah sesi sharing gitu. Silakan mungkin. Jika ingin ada yang disampaikan bisa dituliskan di kolom chat.
Okay, I'm sorry for my absence. Okay, all right. So, what do you think? Where is it? Why? Okay. Okay. Why? Why stock market doesn't play a large role in early stage of development? Okay. Perhaps anybody?
Okay, anybody who wants to answer the questions? Or Professor, maybe you want mention the name.
Okay, it's okay. It's okay. We don't have. By the way, Professor Devia, I have a time up to 2 hours, right? So
Yes.
yeah, so 20-minute time I have.
Yes.
Okay. All right. In that case, perhaps. Okay. One of the large reason. Main reason is actually the corporate companies cannot offer a transparent accounting book. All right. So when you buy the stock of the company, you check perhaps, well, you don't check, but maybe security house or banks who sell a stock to household will check. I mean, nobody they check, but many of the accounting book of company are not well organized, not in a presentable way. So the accounting book doesn't give lots of information, and sometimes company has a multiple accounting books, one for tax reason, one for investor relation, another for themselves. So households cannot trust the accounting book of the company. That's why actually stock market doesn't doesn't play much role. So in that case, company have to depends on banks for their loans. Okay. Okay. Bank-based system. Bank can make lending decision based on the relationship, which helps increase credit availability of two firms and individuals and potentially lower collateral requirement when information is limited. Okay. And the bank tend to know their customers and the community. So, okay, we stock market, well, corporate bond market cannot finance banks. I mean, stock market and corporate bond market cannot finance companies' investment, but banks can, because commercial bank, the staff for the commercial bank frequently visit these companies, and then he or she has a good idea about credit worthiness of these companies. So that's why, based on the relationship between banks and company, banks extend loans. So this is called relationship banking. The bank acquired about firms and can induce better corporate governance. Yes, bank-based system offer better risk sharing over time, better than the market. Yeah, because banks know the customer better than corporate bond market. Okay. And the capital market. markets are better at encouraging innovative, high growth project and compared to banks, which tend to have a bias toward prudence against high risk project. Okay. Okay. This is another reasons why bank based market, bank based lending is actually it's good for early stage of development, but market-based system is better for when the country develops. Okay, because all right, when the country is in the early stage development, you know where you invest. Okay, normally perhaps maybe labor intensive industries such as garment or maybe clothing or maybe processing, which country has a comparative advantage. So for banks, it's easy to distinguish good business model and bad business model. But when when the country is developed, like the United States or maybe European countries, there's no indications, no rule of thumb, which one you can invest. So in that case, you have to take a risk. And then which system is better suited to taking risk? It's actually market basis. Why? Because what are the liability side of banks' balance sheet? Deposit, right? As I mentioned before, innocent people, household deposit her or his money, saving, hoping he or she can use this saving after her or his retirement. So it's very important. Depositor wants no risk. So that's why actually asset side of banks asset side of banks, which is actually loans, loan has to be less risk. So banks cannot invest, banks cannot extend the loan to the high risk project. But on the other hand, corporate bond market or equity, investor knows they are taking risk. So bond market, corporate bond market and the equity market can take higher risk, so which suit to the developed countries, because there's no signal. No manual for which industries banks can invest or investor can invest in case of developed countries. It could be IT, but IT is very risky, and but in case of early stage development, you know where to invest. It could be labor intensive product or industries. So for these reasons, when the country develops, it maybe market-based system is better than bank-based system, financial system. Okay. Market. All right. Okay. Market can. Okay. I have 10 minutes. Okay. Market can help put pressure to replace inefficient, incompetent managers. Okay. Market. Okay. Especially when the bank's incentives to exercise corporate control are distorted and prevent outsiders from replacing incompetent manager. This is a case for family-owned companies. All right. That means actually, if you're stock companies, if you're listed companies, you have to have a sort of stockholder meeting every year, and then in that meeting, the owner of stock can give the pressure to the managers of the market. Okay, all right. Let me move on to more important topics. Okay, all right. Yeah, this is this chart shows what country are based on banks and what country are based on market. So United States, more than maybe 70% of finance are actually through market. And then, all right, I'm sorry, UK. UK is actually, I'm very sorry, I made a mistake. UK is actually bank based. So bank lending is huge. So is in Japan. But Netherlands, okay, Thailand, oh, interesting, are more market based. What about Indonesia? Do we have Indonesia here? Yes, Indonesia also, okay. Oh, interesting. We have Indonesia here. Here. Okay, here we have Indonesia. So Indonesia, in case of Indonesia, bank and market 50-50, almost 50-50. Good, good, good. That's good to know. Okay. All right. Okay, this is bank advantage. Okay. Maybe, okay. This is last. Okay. Let me explain why banks are dominated in the early stage of development. Okay, informational advantage. Banks, because company use bank account for settlement, how much they are paying, and then what timing, how fast they are paying. Yeah? So that's very much financial information used for lending. So bank has information. That's why screening and monitoring. Bank is in a unique position to monitor the financial activities of the depositors or firms using its payment system. Well, it's similar to information advantage. Using this information, banks can search for and screen the best potential borrowers. Bank can request firms submit information. Yes. In case of corporate bond market, you cannot request borrower to disclose information, but banks can. Access to control tools. As a lender, banks has access to control tools that are more effective than those available to other lenders. For example, banks generally require their own customer to maintain deposit at the banks. So yes, when the banks banks suspect the risk of the company, they can look at the deposit at their bank account. Banks are also in charge of creating money. Commercial bank is the main provider of saving instrument, playing a leading role in financial intermediation and the maturity transformation of saving, and functioning as a major domestic creditor of the government and saving as a key participant in the money and the foreign exchange market. Okay. All right. Let me. Okay. Okay. Maybe we need. Okay. Let me explain in case of Japan, perhaps. Maybe that last perhaps topics. Okay. Japan financial system has largely been a main bank system in which most companies have a relationship with several banks. But each identifies one main bank with which it maintains a special relationship. Okay, that means actually, all right, Toyota, let's say, I don't know the main bank or not, but Toyota the main bank is, let's say, Mizuho. Toyota borrows from many countries, I mean, many banks, maybe 20, 30 banks, but main bank is Mizuho. When the main bank is Mizuho, in that case, no other banks extend loans unless Mizuho said yes. So one of the reasons is perhaps from the bank's point of view, they share the profit with many competitors. The main bank is the largest company lender, and sometimes is one of the largest shareholders, and tend to have a director on the company's board. Okay, and then only main bank can send their staff in their managing board, so that the banks has good information about what's going on in the companies. Today, the Japanese banking sector mainly consists of several types of banks that serve different types of client. City banks and other large banks, for instance, have nationwide network and overseas operation that serve large Japanese companies, while regional banks primarily serve domestic client bases. Big Mizuho, which is Citibank, can lend to Toyota, but I'm from Nagoya, so Nagoya Bank can lend small and medium-sized enterprises mainly. Then we have another financial institution, credit cooperatives or credit unions, serve mainly farmers in the agriculture, forestry, and the fishery industries. Okay. Perhaps different from Indonesia. In case of Japan, we have a law that prohibit Citibank to lend SMEs. Well, not strictly operated, but roughly speaking, Citibank are not supposed to lend to SMEs. And then regional banks, Nagoya banks, can lend SMEs, but Nagoya Bank cannot lend to the customer in such as farmer in agriculture, forestry, the micro enterprises. So there is a kind of three types of banks, and then that's why actually that's one of the reasons why we have low unemployment rate. But another reason is actually why financial market didn't develop very well. Okay. Okay, that's in case of Japan. All right. Perhaps further promoting, let me conclude my lecture today. In order to promote bond secondary market, we need investors which diversified investors that actually, let's say, investors of the bond market are banks, commercial banks, and security houses, and also foreign banks, and then foreign investors, and pension pension institutions. Yeah. Then pension institution is long-term investors. So pension institution and insurance company tend to have a hold bond for a long time. So that's actually is also important for bond market to develop. And then also we need many diversified instrument, 1 year money market, as well as 1 year bond, 1 day money market to 1 year bond, and 30, 40 year bond market. And then in order to promote to extend the maturity, you need to have a good credibility of the government. If you don't trust government, nobody buys long-term bond, because compared with 1-year bond, 30-year bond has high risk. That's why actually, if you don't trust government, then it's very difficult to issue the bond. So that's why Indonesia has 10-year bond, but my experience is not many countries can issue 10-year bond longer than 5 years. Okay, let me stop here. Thank you very much for listening. Let me pass to Professor De Beer.
Okay, thank you, Professor Someya, for the materials. Okay, now we come to the discussion sessions for our audience. If you have any questions, please raise your hands or you can write in the chat column. Okay, we have first questions from Mr. Mufti Kandaga. Yeah, in bank-based versus market-based discussions, currently Indonesia has very high credit rate, even compared to neighboring countries. Yeah. Should Indonesia move toward more market-based, and can it make the credit rate can be decreased?
Okay, all right. Well, you mean the credit rating of the government, I guess.
I'm sorry, Professor.
Yes.
This is me currently asking.
Mm-hmm.
It's for the consumer credit.
Okay, consumer credit. Okay.
Yeah.
Okay. All right. Okay, consumer credit. Okay, let me check. Okay. All right. So, consumer credit is actually depends on consumers. Some consumer has a high credit, and then some consumer has low credit. So, okay, move to total. Okay, and then perhaps okay, bank-based system and market-based system. The difference doesn't affect very much about credit rating of the consumers. In case of corporate bond and then government bond, it affects very much. Well, not very much, but some. Okay, in terms of let's say corporate bond market, all right. If the country is more market basis, then liquidity for corporate bond is high. So it's easy to access to finance through corporate bond market. Okay, if you don't have a corporate bond market, then you have only one choice to borrow to finance your project through banks. Banks, but has a sometimes problem holding low price government debt, government bond, or sometimes they are not very how can I say they are very careful about extending loans because their liability side is deposit. Yeah, so that affects a little bit. Yeah, but not consumer. That's what I understand. Did I answer to you? I guess, I'm not sure.
Oh yes, thank you.
Okay, thank you, Mr. Mufti and Professor Someya. Is there any question again? Okay, while waiting for the audience, Professor Someya, actually, according to you, what is the most striking difference in the capital market and the banking system between developed and the developing countries?
Okay, so banking system, the difference in banking system between developed and the developing countries. Okay, well, okay, what is the major differences between? Okay, perhaps. Well, what is the difference? This is tough question. Okay. Well, what are the major difference between in banking system? Okay. Perhaps. The major difference is actually perhaps because of institutional development. Developed countries, banks in developing country, banks in developed country tend to give loans, more loans. I mean, so access to bank financing is easier in developed countries than developing countries. Why? Why? Because all right, perhaps Indonesia has a consumer credit bureau, but many developing countries do not have a consumer credit bureau. That consumer credit bureau collects information, financial information of individuals, such as the history of your payment to power utilities, water and electricity and gas. If you pay constantly every month, then you have a good credit histories. And then if you buy expensive consumer appliances, and then you pay by credit card, it's gonna build up. Also, it's good for credit histories. These informations are gathered by credit bureaus. Then banks, when they lend and lend the loan to consumers, they check the credit history at the credit bureau. And then if you don't have a credit bureau, then banks are very careful, very much conservative in lending to consumers. And also the function of guarantee companies. If in case of developing countries, there is not many credit guarantee companies. But in case of developed countries, credit guarantee companies are there, and then they give guarantee to consumer credit. So from the consumer viewpoint, it's easier to borrow from the banks. While in developing countries, because of lack of guarantee, banks are very much careful and conservative in extending loans. So that's the perhaps difference between. Well, banking system may be the same, but activity, bank lend, the attitude for the banks to lend loans is maybe different, and different between developed country and developing countries. And then that's because of institutional development. That's what I think.
Okay, thank you, Professor, for the answer. Okay, we have the second questions from Mr. Muhammad Faisal. Yeah, he asks again. What are the differences between bond market in Japan before the Japan economic miracle and after the economic miracle? And what are the impact for Indonesia?
Okay. All right. All right. Well, bond market itself improved. Okay. Japan has the second largest bond market. Why? It's easy, because government debt is very large. Yeah. So government debt started increasing 1990s. So last 30 years, government bond increased and the government bond market has increased. So that's the difference, major difference. But let me tell you, let me talk about how we finance early stage of our economic development. That actually 100 years ago. we had a kind of seclusion period, 300 years, around 300 years before Meiji era, before we opened the countries 150 years ago. Yeah, 150 years ago, we opened the countries, and we had, we started developing, and then we saw UK, France, United States, they are very much developed, and they had many institutions like metro station, train station. Yeah, so we also wanted to build train stations. Nowadays, what would you like to do? You want to borrow from the World Bank, or maybe you want to borrow from bilateral donors, right? But at that time, there's no ODA. There's no World Bank or bilateral donor. There was no bilateral donors. What Japanese government did was Japanese government, I mean, staff in the Japanese government visited London. At that time, London was offers largest capital in the world. So the government officials visited London, and then visited investors, many investors, and then one of the investors was actually now very famous family, Rothschild. Yeah, Rothschild, which Rothschild family is one of the largest financial family in the world, and then so Japanese government staff visited many investors, which include Rothschild, and then explained, we want to borrow, we want to issue bond in London, but we are going to build train network, and then we are going to pay back out of fees from train stations. Yeah. So we so that's how we got money from international capital market. So usually nowadays, initial stage in early stage of economic development, country borrow from the World Bank or maybe African Development Bank or Asian Development Bank, but they offer cheap loans, and then also you can borrow from bilateral donors. But in early stage of development of Japan, those institutions were not there, so we borrowed in that way. So that's why actually borrowing capital market, international capital market is actually only choice at that time. And then, of course, that can be a good, alternative choice for current developing countries. And then let me read you this. All right, and then.
Yeah, from Mrs. Enda.
Okay. What is question? I want to ask you a question in the context of development of international capital market, development of stock exchange, increasing globalized and related. The importance of globalization of financial market, including the capital market and stock exchange, is increasing. In your opinion, does globalization of financial market and development of growing global banks and investment fund increase the level of potential systemic risks? Oh yes, you are right. Yes, that's true. Okay. So does the globalization of financial market and the development of growing global banks and the investment fund increase? Yes, level of potential systemic risk. Yes, and they increase the risk of destabilization on many capital markets. Yes, does increase the likelihood of generating another global financial crisis like what happened. Yes, yes, you're right. She's very good. Well, I mean, I'm not sure she's she or not, he, but this question is very good. And usually, let's say economic growth on the vertical axis, and then per capita GDP in the financial market development on the vertical axis, and then no, I'm sorry. I'm sorry. Financial market, development of financial market on the horizontal axis. So if you go to this way, more developed financial market, and then vertical line is economic growth. Yeah. And then the relation is initial stage of development is like this. So economy grows and the financial market grows. But at some point, economy grows actually, economy grows, financial market declines. So the relation changes at some point. Why? Because financial market, financial crisis. Yeah. So if the market goes up, well, financial market developed very much, then perhaps sometimes you lose economic growth. Yeah, because of that's why actually managing risk is crucial right now. Okay. Did I answer to you? Oh, okay. Yeah.
Is it clear, Mrs. Enda? Mrs. Enda? Okay, maybe we can move to the next questions from Rima, yeah, from
okay. Okay.
From Rima Melati.
Okay. Okay, Rima. Okay. Perhaps. Oh, okay. Another one. Okay. Okay. All right. All right. Oh, Rima Melati. Would you like to ask? In one of the research articles from Fan Yang found that the down a spiral effect between financial development. Okay. Perhaps I answered this to this question, yeah, unintendedly. Yes. So the relationship financial market and economic growth is actually positive in the early stage of development, but at some point it becomes turned to negative as financial market grows. Actually, economic growth rate goes down because of financial crisis, which happened 2012. I mean 2010 Greek crisis, as well as Lehman shock, and perhaps Asian financial crisis as well. So, so the only or the response to to avoid financial crisis is actually monitoring. So that's why actually in Japan, Financial Service Agency (FSA) actually visit all the financial institutions periodically and check what they are doing, and then they intervene the lending. But on one hand, if you on one hand, as a consequence of intervention by FSA, financial market banks become very much safe. But that on the other hand, downside of this safe banking sector is actually decline in lending. Banks, because of instruction by financial service agency, bank become very conservative. Banks don't lend. Then, okay, no investment by the corporate sector, and then no GDP growth rate. So we have to balance managing risk as well as economic growth. That's the important factors from now on. Okay.
Okay, any other questions from the audience?
Thank you so much, Prof, for your explanation. It's great.
Okay, thank you, Mrs. Rima. Okay, Professor, according to you, is there any differences related financial inclusions between developed and developing countries?
The difference in the financial institutions.
Yes.
Okay. All right. Okay. Well, one. Okay. Perhaps clear difference between financial institution between developed country and developing countries. Actually, the developed countries they have a more diversified financial institutions, like let's say security. I mean insurance companies, and also pension fund. Um, these long-term investor plays pivotal role in the market development. For example, maybe everybody knows if stock price goes up, you can gain. But stock price go down, you can also gain. This is called short selling, which I mentioned. I didn't explain, but I mean, which is available in the my material. But okay, long-term investor like an insurance company buys Toyota stock and then hold for 10 years, more than 10 years. Yeah, all right, maybe 10 years. Okay, I know Toyota stock goes down. So I go to Toyota and then, can I borrow your Toyota stock? I mean, I go to insurance companies and then who has a Toyota stock, and then ask insurance company, may I borrow your Toyota stock, one stock? Right now it's 100. Yeah. Okay. And then he said, I mean, this insurance company said, okay, then I borrow one stock of Toyota and then sell and then get cash 100. And then I knew Toyota stock goes down, falls. So a few months later, Toyota stock fell from 100 to 50. I buy back Toyota stock. Now I have one Toyota stock and 50, right? And then I return this one stock to insurance companies, right? Insurance company is happy. I pay maybe commission 5. As you know, when I bought back this Toyota stock, I had a 50. I paid commission 5. I have 45 still. So this is called short selling. Sometimes people hate. Chinese government prohibited this short selling, but this is also the instrument to promote financial market. And then this short selling is required long-term investors such as pension fund and insurance companies. And then if they don't, if they are not exist, or if their portfolio is very small, their asset is very small, operation is very small, then you cannot do it. So you should have, I mean, you have to have a diversified financial institutions to do that, to do this short selling. And then developed country has a very much diversified financial institution. They have everybody, and particularly United States. Japan is very limited. So that may be the difference between financial institution in developing countries and the financial institution in developed countries. But that's very good question, and I wanted to explain in the material. Thank you very much for giving opportunity, Professor Devia.
Okay, thank you, Professor, for the great explanations. Okay, because the time is up, we have to end these sessions. Okay, as from the presentations from the Professor Someya, we know that the financial market is an important forum in the economy that can accommodate the lenders, borrowers, and of course, there is also regulators to create good governance and transparency. And in its development, there are two financial structures, bank-based and the market-based. Yeah. And for the bank-based system, this is the banks which became the major lenders. And for the market-based systems, the bond and equity markets are the dominant players. Yeah. But between banks and the capital market can complement each other. A bank can make lending decisions based on the relationship, which helps increase credit availability to the firms and individuals. And while capital market can help put pressure to replace inefficient and incompetent managers, especially when banks' incentive to exercise corporate control are distorted and prevent outsiders from replacing incompetent managers. Okay, thank you, Professor Someya, for the great materials today. I hope the presentations and the knowledge will be useful for all of us. Thank you. I return it to the Girin as the Master of Ceremony today. Good afternoon. Wassalamualaikum warahmatullahi wabarakatuh.
Waalaikumsalam warahmatullahi wabarakatuh. Okay, thank you very much, Professor Someya and Ibu Vita. So now we are at the end of our session today. For all participants, please don't forget to fill the attendance form that has been posted on the chat box. Yeah, and tomorrow we will have another 3-in-1 session with Professor Carlos Mendes, also from Nagoya University, with the topics regional disparities in developing countries. We will start the event tomorrow at 9:30 Jakarta times. Yeah. For those of you who haven't registered for the event tomorrow, please do so through the links that you can find in Department of Economics Instagram. Thank you very much for today's session, Professor Masakazu and Ibu Vita. We hope to see you again all in our future event. I think that's all for today. Thank you very much. Good morning and wassalamualaikum warahmatullahi wabarakatuh.
Thank you very much.
Okay, thank you, Prof.